Hello everyone, I'm Chris Sullivan, Head of Customer and Distribution Management for the Central Region of the U.S. and I want to welcome you to our webinar, Tailored Protection, Quick Payments, Is Parametric Insurance Right for You? Leading our discussion today will be Cole Mayer, who has considerable expertise structuring innovative risk solutions, including the parametric products you'll be hearing about shortly. Before we get started, a few logistical details. Make sure everyone can hear the speaker. We've muted all participants. We want this to be an interactive session, so please ask any and all questions you have. If you do have a question, please type it in the box at the bottom left side of your screen. I'll be reading them during the Q&A session at the end of Cole's talk. If you experience any technical difficulties during the webinar, please do a force refresh by pressing Control F5 without leaving the On24 platform. Again, that's Control F5. With that, I want to thank you so much for joining us today. And now, Cole, over to you.
Thank you, Chris. Hello, everybody, and thank you, everybody, for joining today. First and foremost, I hope everybody is doing well, healthy in these unprecedented times that we face, and we're finding more than ever our clients very much need us, and parametric insurance is one of those areas where we feel we can really help. So pleasure to join you, and thank you for spending the next hour or so of your day with us. Okay. Okay, everybody. So sorry for the technical difficulties. I'm getting a little bit of an echo with Chris here, so I apologize. Let me work this through really quickly. Okay, thank you, everybody. All right, sorry about that. Sorry for the technical difficulties there. Had an extra window open. So again, my apologies, everybody. Starting off difficult way, but great. Sorry about that. So I've switched over to the agenda slide here. Thank you for your patience. Just kind of taking you through a couple different areas here. First, the market situation. What are we dealing with here right now? Parametric basics, just kind of high level, how does a parametric cover work? We'll get into hurricane, obviously quite pressing given the upcoming hurricane season. Earthquake as well we'll get into. We'll think through kind of also how to approach other perils with respect to using kind of unique triggers from kind of a parametric perspective. And then finally, I'll try to leave as much time for Q&A as possible at the end. Okay, so jumping right in, where are we now? So this shouldn't be news to anybody on the line here. Our clients, brokers, really everyone is facing a couple very significant challenges that are all sort of happening at the same time. So revenue shortage is obviously one, resulting from the COVID-19 developments, and along with that, considerable economic uncertainty. That's happening sort of at the same time and with the backdrop of a very much changing insurance market as well. So hardening rates, increased retentions, as well as reduced limits and excluded coverages. So that confluence is creating a real challenge for our clients. What this means is, among other things, they need quick liquidity after a loss, as well as flexible use of the claims funds post-loss. And so these two needs are areas where we feel parametric insurance can really help sort of fill the gap and supplement very well the overall kind of risk management strategy for our clients. So with that, let's go into what is parametric insurance. So there's sort of a lot out there and some understanding, some misunderstanding with respect to what parametric insurance is. So maybe just to ground ourselves a little bit, at a very high level, parametric insurance involves creating or agreeing on a pre-agreed trigger ahead of time. So that can be, as you can see the list there, a physical parameter. So you'll see, for example, hurricane wind speed, earthquake shake intensity as examples. That also could be other types of data, and we'll get into that a little bit with the other perils section of our presentation here. But the key here is we're selecting a pre-agreed trigger to adjudicate a claim as opposed to the more traditional actual loss sustained claims adjustment. So you are all familiar with the concept of kind of the indemnity-based claims adjustment. So the traditional policy, you have a loss, the claims adjuster comes in, assesses the damage, assesses the revenue or extra expense disruption, and that gets adjusted after the fact. With parametric insurance, what we're really trying to do with that pre-agreed trigger is in a way pre-adjudicate that claim, right? So we can significantly speed up the process of indemnification for our clients. So you can see the process down below. The event occurs, that's that sort of explosion on the left there. We confirm the trigger, that pre-agreed trigger, and the intensity of that event. We issue a payment, typically within 30 days. And then there's a loss confirmation step. So this is actually required for these contracts to be considered insurance. The insured cannot profit from an insurance coverage, so there is a loss confirmation step. We try to make that as easy as possible, sort of with two things. One, a very, very broad cover, so a high amount of flexibility with respect to how the insured can use the funds. And it's quite a simple confirmation process. So typically about a year after the event, the insured signs a piece of paper that confirms that in fact the insured's loss met or exceeded the payout. In other words, the insured did not profit from this parametric cover. Okay, so as you can see, quite a kind of an abbreviated process, if you will, compared to how the traditional claims adjustment process would work. So why do folks buy parametric insurance? There's a lot of reasons, and we're sort of uncovering new ones each and every day, but they tend to fall into sort of a few high-level categories. So the first is speed, there on the left. So we touched on this briefly on the last slide, but these typically will pay within 30 days, so much, much quicker, particularly in a large natural catastrophe event, than your typical traditional Nat Cat cover might pay. So this gives the insured an infusion of liquidity or cash when they need it most, number one, and also kind of helps them bridge the gap between the loss and their traditional claims adjustment on their traditional policy. And this is where we think parametric insurance and traditional insurance dovetail quite well together and are quite powerful when used together. Another reason, big reason why folks buy is the broad cover. So again, we touched on this a little bit when we talked about loss confirmation, but once the insured receives those funds, they can use that for any loss associated with the event. And it really is that broad. So it could be physical damage, infilling deductible, covering excluded expenses in traditional. It also could be more indirect expenses or loss, such as wide area damage, right? The insured suffers or does not suffer physical damage, but suffers loss, revenue loss, or extra expense as a result of damage in a wider area. All of that would be considered covered loss under this policy. So quite broad in terms of how that can be used. And the third pillar there is flexibility. So this flexibility is both in the structuring of the product ahead of time. So it's quite bespoke, if you will, in terms of how the cover can be structured to fit the client's exposure and need. Also flexible with respect to the use of the funds, which kind of goes with that broad cover aspect there in the second pillar. So speed, the broad cover, and the flexibility of the cover with respect to both product design as well as the use of the funds. These tend to be kind of the three main areas or reasons why insureds consider and ultimately buy parametric insurance. So we get many questions with respect to how can parametric insurance fit into my overall risk management program. And some, I think there's some misconception out there that it sort of has to be all or nothing, right? It has to be parametric entirely or traditional insurance entirely. And we don't feel that's the case at all. In fact, we think parametric insurance as part of a broader risk management framework fits in very, very well. So you can see, we sort of think about this as kind of a risk management stool, if you will. So you can see on one leg of that stool is parametric. Another leg is your indemnity program, for example. And then you have other, areas or tools as well. Federal aid, FEMA in the U.S., for example, loans that you might have access to. So we think when used together, it creates a very powerful risk management framework, and they complement each other quite well. So maybe just to dig into that a little bit, so parametric can be used in conjunction with your traditional natural catastrophe cover, for example, to help infill your large nat cat deductible. We talked about that briefly. Cover excluded expenses, so debris removal, outdoor property, that sort of stuff, even to kind of bolster limits if you can't find sufficient limits in the traditional market. So again, because parametric pays quite quickly and is very broad, indemnity, you can typically buy large limits. It does pretty well for what it's intended to cover, but takes a little longer to adjust. So together, those work very, very well, we think. Okay, so obviously hurricane season is coming up very quickly. I actually looked this morning, and there's already kind of a formation in the Atlantic. It hasn't formed into a tropical system yet, but it seems that we might be in for quite an active season again this year. And even, again, sort of on the backdrop of COVID-19 becomes more important for our insureds to manage that risk. So let's talk about briefly what's available from a hurricane parametric perspective. So you can see three pillars there as well. The kind of version 1.0, we think about kind of version 1.0 is a cat in a circle. Many on the phone may be familiar with that concept. Pretty simple concept that's been around in the market for a long time. So simply put, you add a point on the map, you draw a circle around it. If the eye of a storm pierces that circle with a certain intensity, the cover pays. And so pretty straightforward approach. Uses publicly available data, typically National Hurricane Center data. So it's fairly simple, and that's one of the advantages. One of the challenges or difficulties with this type of cover, and one of the reasons why we've sort of evolved away from it, is there is a bit of a hit or miss factor here. So depending on how big you make the circle around your location, it's possible that a storm tracks outside of that circle, but the wind that you experience at your site is still very significant, right? So you have a bit of a miss factor there. You're trying to guess what ultimately the wind speed or the damage that you experience will be based on the location of the eye of the storm, which can be challenging. So moving on to kind of version 1.1, if you will, that's an anemometer-based approach. So anemometer is simply a wind measurement station. So that, as the name might imply, is simply you're using a wind measurement from an anemometer to adjust the policy. So that's the trigger. The advantage, again, is it's fairly simple, right? You're using a physical measurement from a physical measurement station, right? A couple challenges with this approach. One is potential failure. So, whenever you're using a physical station that's kind of in the middle of a very chaotic system, you do have the potential for instrument failure, right? So you do want to make sure you build in a kind of a very robust backup in place, just in case those fail. The other challenge with physical measurement stations is you are sort of beholden to where those measurement stations are, right? So if your location is very close to one of the measurement stations, it can work pretty well, right? But if you're, for example, 10 or 20 miles away, that can be a bit more challenging, right? The cover doesn't work very well for you anymore because the conditions at the anemometer could be very different than the conditions you experience at your site. So moving over to version 2.0, this is the wind footprint approach. So this is the approach that we at Swiss Re have adopted and used for quite a while now, and we think sort of is the best of both worlds, if you will. So ultimately what this uses is what we call a high-resolution wind footprint. You can see a picture of that there on the right from our data provider, RMS H-Wind. So what they do is they collect approximately 40 different data sources that ultimately are used to develop a footprint that tells us really at any given point in the affected area of the storm, the wind speed. Right? So what that means is no matter where your insured location is, from this wind footprint using many different data sources, we can know at a very granular level what the maximum wind speed was in that system very near or at your location. So we get to the conditions very close to your site. Also, we're not reliant on one physical measurement station. There are so many data sources that RMS H-Wind is using that if one particular source fails, one particular anemometer, for example, there are many other data sources to sort of supplement that. So it's very robust and very reliable. So with that, our Swiss Re STORM product. So this is a wind footprint, a wind speed intensity approach that we just mentioned in the previous slide. And you can see some of those bubbles there on the left that kind of summarize the basic steps. But there are really three steps involved in structuring these covers. So one is defining a geographic point on the map, right, or series of points. So that's a latitude, longitude point. Okay. The second step is defining a limit associated with that point or points. And the third step is defining what we call a payout table. So the payout table, simply put, summarizes how much we will pay you, the insured, at a given wind speed. And you'll see an example of that here in just a minute, but typically that steps up, what we call steps up. So usually it'll pay a portion of the limit, relatively small portion, at lower intensity wind speeds. As that scales up, as the intensity of the event scales up, the proportion of the limit we pay out scales up as well. So as the intensity of the event increases, we pay you more money. And you'll see an example of a payout table there in just a minute. Okay, so we've defined a geographic point, we've defined a limit associated with that point, and we've defined a payout table that tells you, the insured, how much we'll pay you at a given wind speed at that point. Okay, we would execute the policy just like we would any other insurance contract. When the event occurs, we pull that wind footprint from RMS H-Wind, which our data provider I just mentioned a couple minutes ago. They give us that wind footprint. You can see an example of that on the right. This is Hurricane Hurricane Michael footprint over the panhandle of Florida. We pull that wind footprint. Behind that footprint, there's many data points that tell us at or very close to your site what the maximum sustained wind speed was in that event for the geographic point that we defined in step one. We compare that to the payout table, and if a payout is warranted, we would pay typically, again, within 30 days of the event. And the final step there is that loss confirmation step that we talked about a few minutes ago. Just to reiterate, the insured collects the funds, can use that for any loss associated with the event. Typically about a year later, the insured attests to us that they have in fact suffered at least that amount of loss. So they haven't profited from this insurance cover. So those are the basic steps with respect to how our storm wind speed exceedance cover would work. So to help hammer this point home, we've put together sort of an example structure and event payout to show you how this would kind of play out in sort of a real life event. So you can see the sample terms there in the gray box up at the top. So here it's a $10 million limit. The trigger is the maximum 1-minute sustained wind speed reported by RMS Wind, our data provider, at the insured location that we define. So that's the geographic lat-long point that we define. You can see the insured location there. And then there's an example of a payout table, kind of that fourth line there. So you can see here, starting at 70 miles per hour at the insured location, we would pay 20% of the limit, or $2 million. That would scale up as the intensity of the event increases. So at 80 miles per hour, we would pay 40%, and that scales up to 100% payout at 110 miles per hour. So step one, if we kind of look at how a loss scenario would pay out here, so the event occurs, the hurricane occurs, you can see your site or the insured location, that's that yellow house there in that picture on the bottom left there. We would pull the wind footprint from RMS Wind. In this particular event, so this is actually Hurricane Harvey, so you can see Corpus Christi there, and this location sits a little bit northeast of there. The wind speed in this case at the insured location was 96.95 miles per hour, and that results in a 60% payout, or $6 million. Okay, so relatively straightforward. Event occurs, we pull the wind speed at that point, we compare that to the payout table, and we pay according to the payout table. Okay, so moving on to earthquake to give you kind of a flavor. And this is going to look somewhat similar. So the good news is we've kind of gone over the key details for how the hurricane structures work, what's available in the market. You'll see a lot of similarities with respect to the product design and what's available and even how we at Swiss Re approach it. So on the earthquake side, you can see there's a couple kind of main products, if you will, that are available. So one should be very familiar to you from a few minutes ago, is the cat in a circle. So that's kind of version 1.0. Again, been around for a long time in the market. The concept is very similar to what we just talked about, right? Which is you define an insured location or a point on the map, draw a circle or a box, so it can be a cat in a box as well, around that insured location. If an earthquake occurs with an epicenter within that box and an intensity, typically a magnitude of a certain predefined level, that would trigger the coverage. So the epicenter has to be within that circle or box, and the typically magnitude would have to be a certain predefined level in order to trigger. So again, that cover has been around for a long time. We've evolved away from that, and I'll get into why in just a minute. So version 2.0 is what we call a shake intensity cover, and this kind of goes hand in hand with our QUAKE product that I'll show you in just a minute. This uses the shake intensity at a certain geographic point, so the insured location, for example, shake intensity being how hard the earth shakes, right, at a certain point on the map. Right? So what this does is get a little bit closer to the conditions that the insured is actually seeing on the ground, rather than sort of trying to guess based on the location of the epicenter and the magnitude of the event, what the intensity is at a given point. We're getting straight to that intensity itself with version 2.0. And this utilizes what's called a shake map from the USGS, the United States Geological Survey. Many of you might be familiar with that, with the shake maps or with the USGS. Very, very good data and very granular data. So it gives us sort of a footprint very similar to what we get from RMS Wind. In this case, USGS is publicly available, so everybody can sort of log in and look at it. And again, very great science and great data. So why do we use this shake intensity measure as opposed to what many of us are familiar with from the news, for example, right? Magnitude is typically, moment magnitude is what's reported for a given earthquake. So, 7.4, 7.8, et cetera. The magnitude is simply the measure of the energy released at the epicenter. So that does tell you something about the event, right? The higher the amount of energy, typically the more intense the shaking is going to be in the affected area. What the magnitude doesn't tell you, though, is how that energy unfolds into shake intensities on the ground in a given location. And so there's a lot that can affect that. So soil quality, for example, is one that we all kind of know about. Liquefaction potential, proximity to the fault could be another. So what that means is you might have a location that sits closer to an epicenter that might shake less hard, if you will, than a location further away from the epicenter that just happens to have the conditions and the energy just happened to unfold a certain way that the shake intensity was higher further away at a given area. So what that means is when you're trying to pick, the size of a box or a size of a circle and the location of the epicenter, it becomes, again, there's a little bit more of a hit or miss factor there because you're ultimately trying to guess how that energy unfolds into shake intensity on the ground. So what we've moved toward with version 2.0, so the shake intensity product, is we want to get to what the shake intensity is or how hard the earth shook at a given point. So at your insured location, for example. So what we're able to do is we define a point on the map. The shake intensity will actually tell us, again, or the shake map rather, will tell us at a given location what was the shake intensity or how hard did the earth shake. And we want to use that ultimately to adjust and apply the payout table to rather than the magnitude of the event. So there are a number of intensity measures. The one we at Swiss Re use is called spectral acceleration, a very scientific sounding term. But again, it's simply the measure of the acceleration of the earth from side to side, or in other words, how hard is the earth shaking from side to side. So looking at our Quake product, again, this is going to look fairly similar to how we approach our storm product or our hurricane product. So again, here what we're doing is we're defining a geographic point on the map or a series of geographic points. We are then applying limits to those points or point, and we're selecting a payout table. So the same three steps. Obviously, we're dealing with a different peril, but the concept, the fundamental concept is the same. Define the location, apply the limit, define the payout table. So again, the payout table is going to look very similar to what you saw from a hurricane perspective in that it will be stepped. So as the intensity of the event increases, we pay you, the insured, more money. Okay, so we define the location, we apply the limit, we define the payout table. We would then execute the policy, just like we would, again, any other insurance contract. When the earthquake occurs, we would pull the USGS shake map at a pre-agreed time. We would all agree on exactly when we would pull that data. We would look at the shake intensity at those points that we defined there in step one. So how hard did it shake at each of those points? We would compare that to the payout table that we all agreed ahead of time. and we would pay if a payout is warranted. Again, typically within 30 days. And we also have that loss confirmation step at the end. So very similar concept to what you heard a few minutes ago. We pay. The insured has the ability to use that payment for any loss or damage associated with the event. Then about a year later, the insured confirms that, yes, in fact, my loss met or exceeded the payout. So we just had actually a recent payout for the Utah earthquake. Some of you may be familiar with that event, and very happy insured. We were excited as well. We always like, to have more claims sort of under our belt to prove the concept, because we firmly believe in it. So had a nice kind of recent story and recent win there. So to show you an example of how this would play out, again, sort of in a real-world example, the limit here, you can see the sample terms again in the gray box. So the limit here, again, $10 million. The trigger here is now the shake intensity. So that's the spectral acceleration that we talked about earlier, but the intensity of the side-to-side shaking on the ground, as reported by the USGS shake map in an earthquake. The insured location, we define geographic point on a map, or points, so it can be multiple points as well. And then you can see an example of the payout table. So as the intensity of the event scales up, we would pay more as a percentage of that overall $10 million limit. So down there on step 1, the event occurs. The USGS shake map is generated, and we pull that data. So we look at the geographic locations that we've defined. We look at the shake intensity associated with that point, as reported by the USGS. And then there in step 2, we would compare that to the payout table that we predefined, and that would govern the payout. And we would pay again within 30 days of the event. So in this case, the shake intensity in this point, you can see this was the Loma Prieta shake map. You can see there in step 1. So the shake intensity was 88.47. So that falls into sort of that third tier, 60% payout, or $6 million. Okay. So why storm and quake? You've seen a number of different sort of options, both from a parametric hurricane and parametric earthquake perspective. So ultimately, why storm and quake? We've got into a little bit of, some of the potential shortcomings of some of the other structures, but just to kind of reiterate a little bit what we've talked about the past few minutes. So one would be an independent, reliable data provider, and this is something that when you're looking at a parametric insurance cover, no matter who you're buying it from, and no matter what peril you're talking about, you want a few key things with your trigger. So one is you absolutely want it to be independent and third party. So we as the insurer cannot influence it, nor can the insured, right? So it's totally independent and third party, simply based on the best science and data available. So that independence is absolutely key. So for our storm and quake product, RMSH wind is totally third party, separate and distinct from Swiss Re. So we license that data, as do many others. So we cannot influence the data in any way, simply based on the best data and science available. Same with the USGS. USGS data is publicly available. Obviously, they're a government entity. We at Swiss Re cannot influence the results, the shake intensity of the results. Same with the insured. Obviously, they can't influence those results at all. So the independence is absolutely key to having a strong trigger and a robust parametric cover. Same with reliability. So we touched on that point a little bit earlier, but when you're defining a trigger for a parametric cover, the reliability, making sure that that trigger will give you an accurate, robust reading after an event, and these are very chaotic events, very destructive, as we all know. So the reliability, will that data provider be there to give you that accurate result after the event? Everything hinges on that trigger and how that's defined. So it's absolutely key that you have a reliable data provider. Again, with RMS, HWIN, and USGS, they're using many different data sources to ultimately develop their answers, the wind speed and the shake intensity. And so ultimately those are very reliable. If one particular physical measurement station, for example, fails, they have many other data sources to be able to sort of make up for that. So very robust. The quick payout, so we touched on that a little bit earlier. And a number of times, these can pay within 30 days of the event, as opposed to, again, your typical traditional natural catastrophe adjustment could take sometimes months, sometimes years in large events. And so we want to get the insured money as quickly as we possibly can to help them with their immediate expenses post-event. So this third point here is absolutely critical, correlated to the insured's risk. So the triggers and the data providers that we've used, so both RMS, HWIN, and USGS, have the ability to get to the intensity of the event at the insured's location. Right, so this is key. So we're not sort of trying to guess with the structure, okay, what is the intensity going to be if the storm goes here or if the storm goes here? Ultimately, or if the earthquake, unfolds a certain way based on the epicenter location. So ultimately, our data providers can get very close to the intensity of the event, be that wind speed or shake intensity, at or very close to the insured site. No matter where the epicenter is, no matter where the eye of the storm goes. So that's why we feel these sort of version 2.0, our STORM and QUAKE product, get closest to the actual pain or the actual exposure that the insured sees on the ground, the actual experience they have. So very critical. And what that ultimately does with a parametric cover is minimize what is sometimes referred to as basis risk. So because we're trying to pre-adjudicate a claim sort of beforehand with this physical trigger, there is a possibility, obviously, that physical trigger, the physical parameters don't totally match up with the insured's loss. And so what we want to try to do with a parametric cover is minimize that to the very lowest possible. Right? And so that correlation with the insured's risk and the insured's experience at their insured location is absolutely key. The broad coverage, we've talked about that a couple times as well. Again, just to reiterate, the insured gets the payment based on the physical parameters of the event. Once they receive that payment, they can use that for any loss associated with the event. And that includes excluded expenses, retentions in their main program, as well as wide area indirect loss, for example, and kind of anything in between. This is an insurance form, again, so these can be accounted for and are considered insurance just like any other insurance policy that the insured would buy. And they have up to 12 months, about a year, to confirm that loss to us. And we talked about that a couple times. And there's no financial deductible associated with these covers as well. So it's simply, we look at the physical parameters, we compare that to the payout table, and we pay based on that. Okay, so we've kind of talked about the two main perils, I'll say, in terms of where we see the most demand, hurricane and earthquake. But many will ask about other perils as well. And so the concept of parametric triggers, parametric cover, can absolutely be used for other perils as well. So a few key sort of thoughts as you're going about thinking through Can we make a certain trigger a parametric trigger? Is it robust enough, et cetera? So one is that independence and reliability, right? So is this an independent third-party trigger, right, that neither party can influence? Also, is it reliable, right? So can we count on it to give us a good result, an accurate result post-event? Also highly correlated. We talked about that in detail on the last slide. But as you're picking a trigger, it's really critical that that trigger be highly correlated to whatever risk the insured is concerned about. And finally, does it have sufficient historical data for us all to collectively get our hands around the risk, adequately price it, and assess the probability of loss? Sometimes you'll see a trigger that maybe hits the first two, right? It's independent, reliable, it's highly correlated. But as you get to sort of more nuanced perils, if you will, where maybe we don't have as robust a model like we would, for example, for hurricane and earthquake, sometimes we have to build the models, right, from historical data and that sort of thing. And if we don't have that sufficient historical data, it's very difficult for us all, again, to collectively get a handle on the sort of probability of a given event occurring and put a price on that, and also set the appropriate triggers using that trigger to make sure that we hit that second point, which is a high correlation with the insured's risk. So some examples here of areas where you might think about sort of other perils and the use of parametric triggers. So one, we've talked about sort of ad nauseum here, Nat Cat events. So hurricane and earthquake we've talked about in detail. There's also other perils that you can potentially explore. They become a little bit more difficult as you move past hurricane and earthquake. The data for those two perils is very, very good, very granular, and they're also perils that tend to affect kind of a wide area, right? As you get into other events, such as flood, such as hail, we have looked at parametric covers for those perils, and to a certain extent we've had success. They're much more localized perils. So as you get more localized, the need for granularity becomes even higher, right? And that hit or miss factor potentially is a little bit higher. So that's what you need to be very, very careful with as you kind of wade into other perils. Is kind of the localized nature of that peril and the corresponding available data associated with that. But kind of mini Nat Cat events, and there's a number of triggers that you can think through for a number of different perils. Another area might be weather events. So that could be too much rain, not enough rain, too cold, too many cold days, too many hot days. So all of those tend to lend themselves very well to parametric covers because there's excellent data associated with those. Flight traffic might be another one. So if, for example, an insured has a high exposure or high share of revenue, for example, from tourism, right? The flight traffic into a given airport might be a critical point for them, or kind of a high correlation to loss, right? So if the flight traffic decreases considerably for a number of reasons, the insured starts to feel real pain, right? And so you could potentially use that as a trigger. Another might be hospitality rates. So say you have maybe a national hotel chain. It might be very correlated to certain indices, revenue per available room, for example. So if you see a drop there, the insured's risk might be highly correlated to that type of index, for example. And there are many others, as you can appreciate. And it's really, again, the universe is sort of wide open as long as you can kind of think through, and we can collectively think through those top three bullet points, right? Independent, reliable trigger, high correlation to the insured's risk, and sufficient historical data for us to kind of wrap our heads around the probability of risk and potentially where we need to set those triggers. So again, really appreciate you taking the time. Before we get into questions, I'll just do a quick plug for our team. So we always encourage, whether it's parametric or anything else that kind of falls outside of a neat and clean traditional line of business that we do, we always encourage you to give us a call. And you can see that the team, we're kind of a lean team nationally here, but have pretty good geographic representation. So a number of folks in New York as well as on the West Coast where I'm based. And so you can see our contact information. This will be disseminated as well. So always feel free if you have questions that we don't get to here, or if you have any other questions, concerns about anything related to a risk that an insured has that may not be adequately covered on the traditional side, please feel free to reach out. We always encourage those types of conversations.
Cole, thank you so much. That was a fantastic presentation, and I have to give you a lot of credit for bouncing back from the early tech difficulties. I think every one of us can relate to that on this call today in the kind of a new virtual world we're living in. And for me, it's not just limited to that. It often involves children bursting through the door when I'm on video calls. So we have a ton of questions that have come in. So we're gonna get right to it. And just as a reminder, if you want to ask a question, your Q&A box is at the bottom left side of the screen. We're going to try to get to as many as we can. We have about 13 minutes here. And any that we do not answer, we will get to you individually. We will reach out and answer those for you. Okay, so let's get into it. First question, Cole, is can parametric policies be applied to contingent locations? Does it have to be just the insured's location?
Yeah, great question, Chris. And absolutely they can be. So maybe I'll give you a couple examples of areas that we've explored. So one might be a port, for example. So say an insured is a manufacturer or a retailer, right, who gets much or all of their goods or raw materials shipped through a single port. So that may or may not be adequately covered by their traditional CBI limits. Obviously, CBI, contingent business interruption, is a tough cover to get at the moment, particularly with meaningful limits. So we've had a number of insureds look at contingent exposures, simply putting the geographic pin on the port, for example. And that's absolutely, the insured has insurable interest in that port continuing to operate, right? And that's absolutely a legitimate way to kind of structure a cover. So a port would be a perfect example, or any contingent location. Really, that kind of goes back to the flexibility. So we can define those geographic points really anywhere, as long as the insured has legitimate insurable interest in that site operating. So great question, and absolutely yes, these can be used to cover contingent exposures.
We have two questions that I'm going to lump together, Cole, that involve kind of the claims process. So I guess the first part of it is, who adjusts the client's loss to confirm that their loss exceeded the payout? And then the second part of that question really is, what happens if the client's loss ultimately does not exceed the payout?
Sure. Yeah, good question. So the process is really, the event occurs. If we drill into the process a little bit, the event occurs, we ask the insured to develop an initial loss estimate. So that's very early. We expect some conservatism because the insured doesn't really know at that point how the loss will evolve. So based on that, we go ahead and pay the parametric payout. So the insured has the money in hand, can use that as the loss develops over time, right? And ultimately, we ask the insured, again, about a year after the event, to attest to us, so sign a piece of paper that says, I have not made a profit from this cover, or in other words, my loss as defined under the policy, which is very broad, has met or exceeded the payout. So there's really a pretty limited, I would say, loss adjustment process in general, right? So that's really it. Ultimately, we're sort of taking the insured's word from it, for lack of a better term, but that is obviously, a legal attestment from the insured. With respect to and Chris, remind me the second part of the question. Sorry.
It was what happens if the payout doesn't exceed the client's loss?
Yes. Absolutely. Yeah, good question. So,
I'm sorry, Cole. It's
technically,
actually, if the payout exceeds the client's loss. Yep, go ahead. Sorry about that.
Yep, no, absolutely. Yeah, sorry about that. Yeah, so if the payout exceeds the loss, great question. So technically, the insured would owe us the difference back. So that's technically how it works. And again, that's to make sure we stay within kind of the comfy confines of an insurance policy, an insurance concept. However, there's a couple things we do to try to mitigate that. So number one, as we work from a structuring perspective, we work very hard with the insured to set reasonable limits and payouts, given the intensity of the event. So what we're not going to do is structure an insured with a really, really high limit that we don't think there's a high probability that the insured would need post-event. Right? So that's the first piece. We design the payout table and we design the limit to minimize the probability that the insured would have a payout that exceeds the loss. In other words, we're all pretty comfortable that in that event, the insured would suffer at least that amount of loss. The other piece of that is the broadness of the cover, right? So we really, by design, we make the cover as broad as we possibly can, so that the insured can kind of fill that bucket as easily as possible, right? So that could be, again, indirect loss, wide area loss, supplementing deductible, for example. That also could be a bit less apparent things, right? So, for example, the insured's significant increase in next year's premium, natural catastrophe premium on their traditional, right? That's considered loss. It's financial loss resulting from the event, right? So it is quite broad. So the combination of how we set the triggers and the limit, as well as the broadness of the cover, we think that the probability that the insured can't find a way to use all the funds for legitimate loss is quite low. Great question.
Cole, can you cover war risk that would cause a business interruption?
That's a good question. I think the short answer would probably be no. Just to kind of be as clear as I can, and I think the reason would be, ultimately our team and with parametric covers in general, we need to fit within the appetite of the overall Swiss Re group, right? So we don't really manufacture appetite where there isn't kind of an appetite for that risk. The market in general, and I think Swiss Re is no exception, has very limited to no appetite for that sort of war risk. Obviously, it's a standard risk exclusion in traditional policies, and I think we would take that stance as well. So without investigating it further, my honest opinion to start would be war risk would probably be off the table with respect to our appetite. Good question, though.
Next question is, how do you address scenarios where the insured has a large geographical spread of multiple locations?
Yeah, that's a great question. So the examples that you saw in the presentation today are fairly simplistic, right? So we kind of used one location or kind of a handful of locations, if you will, as kind of examples. We've structured many sort of quote unquote more complex covers with many trigger locations or geographic points defined in multiple geographic areas, for example. So we've structured covers that cover both hurricane and earthquake, kind of under the same overall policy. We've structured covers that cover multiple geographic areas within a peril, for example. So, California and Pacific Northwest. So that it does add a layer of complexity to the cover, but it's absolutely doable to cover kind of multiple geographic areas. And ultimately, again, the flexibility of the structuring kind of allows us to do many different things, and ultimately then we would work very closely with the insured to ensure that we're covering their risk the way they need us to cover it. But larger geographic locations or distributions, if you will, are very doable under these covers. Maybe a bit more work, a bit more heavy lifting, but very doable nonetheless.
Cole, next question, I'm just going to combine two questions here. It's one, what is required for submission for parametric solution? And then how much time? What's the timeline look like typically?
Yeah, good question. So from a submission perspective, it's generally much less onerous or much less information than we might need for a traditional property submission, for example. Really, to get us started, a simple schedule of values is really what we need, so the geographic location. If it's if it's sort of a contingent location or they're looking to cover kind of a different exposure, we may need to dig a little bit deeper there, but typically just a schedule of values. And then, an idea, if you have it, of a couple things. So how you might want to use the parametric cover, what's the intent in terms of how that would fit into your broader kind of risk management strategy, if you will, kind of what we touched on a few minutes ago. And then a budget, if you have it. That kind of helps us, those two things kind of help us get to the right structure for the insured, and that can kind of save time, which leads to the second point. So typically the turnaround depends on the complexity, Chris, of the cover, but generally, usually 3 weeks or so to kind of get it modeled, structured, tweaked, et cetera. These are all kind of built from scratch, and we don't by definition, we don't take a one-size-fits-all approach. So we do ask for kind of a few weeks. That can be sped up a little bit if the structure is significantly kind of easier, right? So if you've got one or a handful of locations, a little bit easier than dealing with what we talked about a few minutes ago, right? The larger geographic schedules. So it can vary a little bit, but generally we ask for at least 2 to 3 weeks turnaround.
Fantastic. Thank you, Cole. We are out of time for questions. Again, we will answer all that have come in individually. If you think of any others, please feel free to reach out to the team. We're always happy to continue this conversation. Before we sign off, we want to hear from you. So we're gonna push out a poll right now to kind of get your input and insights into what you'd like to hear about for a future webinar. If you have suggestions that fall outside of what the answers are in the poll, feel free to reach out to me via LinkedIn or email at chris_sullivan@swissre.com or via the Swiss Re website contact form and provide those suggestions. We have a lot of experts and a deep bench of resources that we'd love to share, so your input would be extremely valuable for us. Also, keep an eye out for an invitation for an upcoming webinar that'll take place on June 4th, and the topic is going to be international business. So please stay tuned for that. And again, thank you for being here. We appreciate your input. We appreciate your questions and your attention today. We hope you found this to be informative and helpful. You've been a great audience, albeit virtually. And another question I was asked quite a bit, we will be sending a recording out in the coming days, so you'll see that shortly. So if you want to listen in again, to view the presentation again, or share with others, you're welcome to do that. Be well, be safe, and enjoy the rest of the week. Thank you so much.